Hello and welcome to EduFund. In today's episode, we have a very special guest with us, Karthik Raj Lakshmanan. Karthik is a fund manager with UTI Mutual Fund. He brings roughly around 17 years of experience to the table and has worked for ICICI Bank, Goldman Sachs, BNP Paribas, and also ICICI Prudential Mutual Fund before starting with UTI. At UTI, he is the fund manager managing one of the oldest funds in the country, which is UTI Master Share Scheme. Let's hear from the expert today on what has been the challenges and what are the key objectives of the fund and how he has been managing the fund over the period of time. So Karthik, why don't you throw some light on the fund's objective, the strategy, the investment philosophy and the process which you follow to manage the fund?
Hi Neeraj. Like you said, UTI Master Share is a large cap fund which predominantly invests into large cap companies, about 80-85% in large caps and about 10 to 15% in select mid and small cap companies. The idea is to identify companies with good growth at reasonable price, GARP as it is called, and focus on competitive advantages of the companies that we are investing into.
UTI Master Share is a fund which was incorporated in 1986 and the fund has traversed almost 4 decades. So what do you think has changed or what has fundamentally not changed in the fund over the past 4 decades?
From a strategy perspective, we've ensured that there's no change the way the fund is run. The style of the fund is not changed with the change in fund manager. The focus has been on competitive advantage and kind of again the buy and hold strategy.
On the fund, the stock selection process, people generally debate that in large cap, the alpha generation capability is very less because information efficiency is going to be on a very lower side. So in this case, how do you pick the stocks? What is your stock selection process? And how do you actually build the portfolio? Followed by how do you mitigate the risk or control the risk of the overall portfolio?
Whether it's large cap or mid and small cap, the idea is to have the competitive advantage. That's how we look to differentiate. Why look at competitive advantage? Competitive advantage can be, a brand, a distribution reach that the company has, or a cost leadership, or a technology advantage. A parent has some technology in case of MNC, and so on. So these competitive advantages ensure that the company has a longer runway for growth and a better visibility of profitable growth.
We have also seen that investors generally are more fancy about small cap and mid cap space. While I understand that they make more returns over the long-term period if selected well, what do you think? Why are large cap more important and should definitely find a position in anyone's portfolio?
So what we've seen is when we looked at the 5-year rolling returns and adjusted for the risk of volatility in the returns, the large cap stacks reasonably well compared to the mid caps and small caps. As you know, the volatility of the risk is lower in large caps, a little higher in mid caps and highest in small caps. The returns, when you compare it with that kind of volatility, the large caps do stack up very well. And the other point is that from a value or a wealth creation, even in the last 1 or 2 decades, a significant proportion of the wealth has still been created by the top 100 companies or the large caps by definition. Say anywhere between 70 to 75% of the wealth would have still been created by the large caps. From a wealth creation journey perspective, for an average investor, there should be some allocation to large caps as well. Because in many industries, we've seen the large companies or the leaders have often gained market share, especially in the last 5-10 years. We've seen many of the sectors or industries where the large or the leaders have actually gained share. And to that extent, they've compounded their earnings faster, which is reflected in the market cap or wealth creation. So to that extent, we believe large caps makes good bet for anyone from a longer term wealth creation journey.
Would you then bifurcate your philosophy or the style towards either growth or value or a blend of both?
Yeah, so from a style perspective, like I said, it is growth at reasonable price. The idea is, overall at the fund level, there would be a little tilt towards growth and quality. But at the same time, we do have exposure to some of the turnaround situation and some of the value opportunities as well.
So let's talk a little bit more on the risk front. If you look at the fund, almost over the 37 years period, India has gone through multiple scenarios of ups and downs in the economy. How would you mitigate the risk which is inbuilt from an economic angle and also the risks which are there at a fund angle. So how do you mitigate this kind of a risk and volatility?
So from a fund perspective, there are risk parameters that we follow. Some of them are regulatory as well. In an individual stock, we can't have more than 10%. But even internally as well, we keep a restriction of not more than say 35% in a sector. The top 10 concentration not to be more than 55 or 60%. So on and so forth. So these parameters ensure that we really don't take extreme calls on a particular company, sector or so on. So that's from a risk parameter. As far as overall the volatility is concerned, the economy's volatility is lower, the market volatility tends to be far higher.
Okay, often we get a question from our investors saying that market is at 66,000, it's at a very rich valuation right now, we should wait for a correction to put a lump sum. What would be your advice to our retail investors and also how they should play the market or how they should invest? Should it be an SIP route? Should it be a lump sum route? How should they plan their investments?
As we speak, the valuations are slightly higher than the long-term average, probably about 10% higher than the long-term forward Ps. So is it very expensive? Definitely not, but it is expensive than the long-term average. So to that extent, there is some caution which is required. Again, when you compare the returns, when you compare the yields with the bond yields, the gap is little higher than the normal. So from an asset allocation perspective, we are saying fixed income looks a little bit more attractive than equities. But this is far more from a shorter term perspective. As you know, equities is a long-term asset class where you need to have at least 5+ years of horizon. And from that perspective, it may not change much. So for someone who is looking at lump sum, probably staggering the investment may make sense. But as far as SIPs is concerned, it is better to continue with the SIP even if at all the valuations are little expensive.
Any last advice which you would want to give to our viewers related to UTI Master Share Scheme or if you want to share any insights about the last 37 years of journey of UTI Master Share Scheme?
Advice in general for investors is that one needs to understand the riskiness of the product and their own risk appetite. I mean, often the investors believe that they have the risk appetite, but only in a downfall they really realize they have that risk appetite or not. Ideally, the time horizon should be one longer in a product like equities, like I said, at least 5+ years. And two, if at all there are market corrections, it is part and parcel of market. I mean, you will not have a one-way rally up to like Sensex or Nifty, whatever. It's not going to be a one-way rally. You will have ups and downs, you will have corrections. We've had 20+% corrections in the past. We'll have such corrections in the future as well. Rather than panicking at that time and kind of trying to time the market and exiting at the wrong time, be invested for the long term. And if at all there are opportunities and if you have the risk appetite and the room to further invest, use such corrections wisely. So that's the thought process. Need to understand your own risk profile and understand the riskiness of the product as well. And a time horizon should be longer, especially for an asset class like equities.
Thanks a lot, Karthik, for spending time with us and sharing valuable insights with us. I'm sure our viewers would have loved the insights and would draw some conclusions out of this in their investment making decisions. Thanks a lot for giving us time.
Thanks, Neeraj. Thanks for having me on the show.